two major credit agencies, Fitch and Morningstar, put the U.S.'s AAA credit rating on negative watch this week. You may be wondering, what does this mean? Is this a big deal? Should you, as an investor or trader, be worried? Hello everyone, I'm Kathy Lean, and talking about how fundamentals impact the markets is my specialty. I'm going to outline to you 3 ways you can prepare for the potential panic. Based on the initial market reaction on Thursday, where stocks were mildly negative, gold is lower, and the US dollar gained strength against the Japanese yen and Europe, investors really aren't that worried. But don't be fooled by the market's steadiness. Even without a downgrade, there could be big moves in the markets. Currently, the S&P 500 is hovering near 9-month highs, which is kind of reminiscent of 2011 when stocks completely ignored the impending debt crisis. 2011 was the first time ever that a rating agency, Standard & Poor's, stripped the U.S. of its prized AAA rating, and they never got it back. S&P put the U.S. a negative watch on July 15th and downgraded the rating from AAA to AA+ on August 5th. The chart shows here that 2 weeks before the downgrade, right when the negative watch was issued, stocks peaked, falling over 11% before the rating was officially lowered. Gold actually also began to rally before the downgrade, gaining almost 18%. And as you see in this dollar-yen chart, dollar-yen dropped from 81 to 77, a nearly 5% move after the S&P, Standard & Poor's, put the U.S. on negative watch like what just happened now by Fitch and Morningstar. So what does this tell us? Number 1, don't expect a recovery in stocks before the whole debt showdown is over. Number 2, it's probably smarter to lean on the side of short stocks, short dollar, and long gold trades ahead of the X date when the government says it can no longer fulfill all of its financial obligations. And number 3, be prepared for high volatility and big moves. Use wider stops and targets because the trends that can happen afterwards can be very, very significant and generous. As traders, there will be plenty of opportunities. As investors, you should know that the move before a downgrade could actually be bigger than the move afterwards. As you can see in this S&P 500 chart, where stocks actually chopped and bottomed in the 2 months after the rating was lowered. But we saw a very big reaction in the months beforehand, the weeks beforehand, and then also right after the credit rating was lowered to negative, or the credit outlook was lowered to negative. Gold peaked 1 month after the downgrade, and dollar-yen bottomed shortly after. So ride through the initial volatility. Maybe consider putting on some put positions to offset those losses in the near term, and expect the markets to stabilize and the panic to ease a few months later. Now, there's a very good chance that President Biden will seal the deal and congressional leaders reach a deal with congressional leaders before the clock runs out, avoiding a default/downgrade. Once a debt agreement is reached, brace yourself for a robust surge in stocks, an upward leap for the dollar, and a rapid sell-off in gold. These moves could have some serious endurance. Now, if you watched this long, let's talk about why the U.S. debt rating is even important. Why should you care? Well, a U.S. debt rating represents the credit worthiness of the lender, or more importantly, the chance of a default. The U.S. dollar has long been seen as the world's premier reserve currency, and U.S. treasuries are treated as risk-free assets in the minds of investors. In other words, they see the risk of the U.S. Defaulting and not getting their money back as zero. By putting the U.S. credit rating on negative watch, rating agencies are telling us that there's a heightened risk of defaults, no longer zero or close to zero, which would actually be the first time ever if the U.S. defaulted. An actual default would be catastrophic. It would send shockwaves through the global economy, send stocks around the world down 5, 10, maybe even 15% in a blink of an eye, and potentially cause a recession as borrowing costs skyrocket around the world. It is the severity of these consequences that will pressure U.S. politicians to get a deal done because no one, including Biden and McCarthy, wants to be responsible for single-handedly causing the market cap and investment portfolios of their constituents to be decimated for something that's avoidable. It is a kick in the butt for Congress for swift bipartisan action to raise or suspend the debt ceiling and avoid a manufactured crisis for the markets and economy. The consequences are just too severe. But, a downgrade can still happen if there isn't a default, which is what happened in 2011. For now, investors still don't see a default risk as realistic. And there's really isn't a viable alternative to the US dollar as a reserve currency or US treasuries as an asset because it is the largest market in the world and seen as the equivalent to cash. But you still need to know what could happen so you could be prepared, because this complacency that we saw after the initial negative watch could just be the calm before the storm. If you like this video, let me know in the comments below. If you want me to cover more topics, I'm happy to hear what they would be. Don't forget to subscribe to our channel and hit the alert button to be notified of new posts. Finally, if you want to trade with me every day and learn how I use fundamentals to trade, check out the links in the description below.